2008 all over again. Oh, I'll go ahead and agree to that. But we have a lot better fundamentals today than we had, say, back in 2007, right before the big financial crisis. And so we don't see a big wave of foreclosures coming, but prices really over the last year in particular have gotten away from incomes, right? They're not purely just explained by low rates. There's a kind of market competitiveness aspect just due to the chronically undersupplied market. That means that prices have now decoupled from fundamentals. We haven't seen a big sell-off, right? So we don't see sellers dumping homes on the market. And I think rather what you're going to see this time around, because people have equity, because they put money down, right? Because it was mostly mortgages originated to people with really high credit scores, most of the folks who remain employed, et cetera, is that we won't see it on the price side, right? You're not going to have a bunch of people throw the keys back to the bank on homes and then, see the market dry up where the only thing coming onto the MLS was an REO that, was severely discounted, and it became this kind of self-fulfilling prophecy that brought prices down even probably below what would be implied by fundamentals. Rather, what you'll see is that people just won't sell, right? They'll sit on those homes, especially because they've got super low interest rates over the last couple of years, right? And so you'll likely see it probably show up as a reduction in transactions. And I think that's what we're starting to see. So if you put it all together and what it means for us as realtors, right, as agents working with buyers and sellers, I think that we're going to have to really work for it, right? Because you've got a lot of folks with trepidation, economic uncertainty. There's this kind of brother-in-law effect where even though the data doesn't suggest it, you have people who think that prices are about to crash, right, and could be sitting on the sidelines, where in reality, buyers have more options now than they've had in a very long time. We've been waiting for enough listings to put these buyers into, and we're finally starting to see it. The other thing buyers have going for them by acting sooner than later is that rates are probably going to keep going up, right? And if you're planning to live in that home for the long haul, the difference between a 5.5% and a 7.5% interest rate makes a big difference over a 30-year time period. And so you have more choices. You also have a market that's slightly less competitive. You're not fighting over quite as many buyers as you were 6 or 12 months ago. And so folks who've been fatigued, have a chance now. And I think that's a couple of really good reasons why it still makes sense to be in the market, in addition to the fact that that's still the tried and true way that people are actually accumulating wealth, even in this tech economy with Bitcoin and all this, new fancy millionaires. When you look at the aggregate statistics, right, the wealth is generated by people who own homes, and that's what matters at the end of the day. And yet, even as the market's slightly less competitive, it's still a great time to sell, right? Homes are still selling quick, just not as hyper quick as they were last year, right? You're still seeing most homes sell over asking price. It's just 3 out of 5 homes, not 3 out of 4 homes, right? And so again, there's still a lot of reasons to be a seller in this market environment too. But I think that's where we kind of fit in to the picture, right? Because you've got folks who are out there reading newspapers, who are scared to death about the economy, just waiting for the REO, shoe to drop on the housing market. They're not focused on the long-term benefits of home ownership. They're not focused on the fact that the market has shifted to buyers' favor. It's not a buyer's market by any means, but it's not, sellers aren't as firmly in the driver's seat as they were a few months ago. And I think that, again, data is your friend, right? You want to use this data to really show where things are going, where they are now, why these things still make sense. And I think that, the numbers don't lie, and that brother-in-law effect is alive and well. And when you take localized, very specific data that's applicable to your client, it goes a long way towards heading off those kinds of objections at the pass and getting folks focused on what really matters. So that's the kind of good news, bad news side of it. Let's go through the data, because we have seen the markets finally start to show signs of a shift. For the first 4 months, as rates started to rise, the market held up remarkably well. but in May, we finally saw the number of sales retrench a little bit. In fact, we hit 378,000 units on an annualized pace in May. That might not mean anything to you if you're not looking at charts all day long, but that's down 15% from where we were in 2021. But if you look at it as well from a longer term perspective, we're nearing the lowest levels we've been at in the last decade since the end of the 2008 financial crisis, right? And so it's not just that we're kind of moderating from these incredibly high levels last year. The actual level of transactions is moderating down to a level that we haven't seen in quite some time outside of that initial shutdown during the pandemic there in 2020. It's a pretty broad-based decline, right? So you can see Southern California is obviously right up in the mix, but it's true across the entire state, right? Central Coast, where I live, LA, Bay Area, and even some of the smaller counties in the north and northeastern part of California are down, and in most cases down by double digits. One of the really interesting shifts that we've seen is that the top end of the market has started to slow dramatically. If you look at the kind of trajectory of the housing market, this is transaction growth by price segment here in California. You can see that the reason why we had such a strong housing market recovery is because everything from 750,000 on upwards of 2 million plus was growing not just by double digits, but in 2021, those segments of the market were growing by triple digits, right? They were doubling from where they were, in 2020, which was also a relatively strong year after we got past that initial shutdown. Now you can see that growth moderating, and in fact, 2 million and up was the only segment of the market that grew last month. And I think that's, from a Keller Williams Larchmont standpoint, that's a relevant indicator, right? Because the immediate surrounding area is in that kind of dark blue category. It's still outperforming every other price segment, right? But we're not seeing sales double, and in some cases triple and quadruple the way that we were last year. So I'm not trying to scare you. I'm trying to motivate you to stick with it, right? And to stay in it, because it isn't going to be that kind of rising tide that we've had since the end of the pandemic. I just pulled out a smattering of cities in LA County, from kind of highest priced in Beverly Hills down to the lowest price, and I couldn't fit all 88 or how many ever incorporated cities there are in LA. You can get all of those on our website, by the way, if you need localized content. But you can see even within county, right? It's relatively broad based in terms of sales retrenching from where they were last year. And I want to show you where the big shift is in the marketplace, right? Because we talked about sales slowing down at the upper end. Here's growth on a year-to-date basis. First 5 months of 2021 compared to the first 5 months of 2020. And look at what segments of the market were growing just incredibly, right? It was 750 on upward. Now, look where we are today through the first 5 months of 2022, right? You can see that the bottom end of the market, where we have essentially no inventory below 500,000 to speak of, is still in decline, right? But the biggest difference is at that top end of the market, which is still growing very modestly. But again, we're just not seeing that head and shoulders kind of overperformance that we had enjoyed up to this point in the recovery.
Lunch, boo-boo.
Again, was the thing that was really propping up home sales in terms of generating those kind of 12-year highs for transactions. The top end is still outperforming, which is why we now have a median statewide price of $900,000, right? If you have a $900,000 home, you're now right smack in the middle of the pack, which is kind of crazy. As somebody who grew up in the 80s, when my dad, I think, bought our house for like 60 something grand, right? But not just is it a high price point, right? At 900,000, prices are still functionally going up by double digits, right? 9.9% higher than they were last May, right? And so even as the market has started to slow, the top end is still outperforming, just not by that kind of crazy, incredible margin that it was last year. But that's still leading to selling more homes at the top end of the market, which is dragging up our median price into that 900,000 range, right? And we do now think that supply and demand will continue to rebalance. It's not falling off a cliff in demand. We're not seeing a skyrocketing of active listings. The market is kind of coming down from a frenzy and finally rebalancing itself. But that does mean that buyer demand is probably going to continue to pull back in the face of higher rates. We've already seen it a bit in the closed transactions. Pending sales shows that there was a double-digit decline on the number of deals going into escrow, right? So that means that when we put out June and July, we'll probably remain below that 400,000 unit threshold that we finally dipped below last month for the first time. So it's not a cruise control environment where we can just kind of sit back and ride the wave and have all these transactions fall into our lap. We're going to have to really be proactive in a market environment like this, because you can see it on the buyer demand side, right? Purchase applications, this is mortgage purchase applications. We're almost halfway through the year now, but these numbers have been falling from 2021 levels for a while by double digits, right? Because again, last year was a great year for home sales, but you can see over the last 6 weeks or so, we've been consistently underperforming the pre-pandemic level too, right? Not just last year, which was a great number, but 2018 and 19 when things were relatively quote unquote normal. And so my point being is just that you are seeing buyers, whether they're trepidatious about the economy or just simply being priced out by higher rates that they can't afford anything or think they can anymore, taken that step back, and that will eventually filter through to closed transactions, right? You can't put people, you can't close escrow on homes that people have never filled out mortgage applications for, is kind of my point there. And so this is a leading indicator of where we can expect pendings and close to go over the course of the next couple of months. We also expect that it'll probably start to show up in softening price growth as well. We have more active listings now than we've had basically in the last couple of years. In fact, active listings have had a couple of big months of growth. If you compare actives now to where they were at the same time last year, they were up almost 50% from last May, right? So that is taking some of the pressure off the market in terms of generating market competitiveness. And again, I think where some of the opportunity is for buyers as we move forward. Part of it is that reduction in sales, right? So homes aren't selling quite as quick, so we're carrying more homes forward into each month. That's part of the increase in total actives. Part of it is that we're putting more onto the MLS directly, right? And this is the number of new listings that have been added to the MLS every month, not just the snapshot of where actives were last month. And there too, you can see we put more homes on the market in May than we have at any point in the last 2.5 or so years, going back almost 3 years to May of 2019. And that is leading the market to become slightly less frenzied, right? When you kind of put those two things together, the number of home sales and the number of homes that we're putting back onto the MLS to kind of replenish our supplies, as it were, you could see at the onset of the pandemic, two things happened. People stopped putting homes onto the MLS. The blue part went down, and there was this insatiable appetite for homeowners for home ownership, rather, for folks who wanted to get their foot on the property ladder for the first time. And so a big gap opened up between, how many homes we were taking off of the MLS by closing escrow and how many homes we were putting back onto the MLS in terms of new listing. And that created this kind of hyper frenzied competitive environment where sales were essentially going to the highest bidder. We had prices that were going 20-30% increases on a year-to-year basis. Now you can see that those numbers are starting to grow closer together again. So that kind of gap, that huge imbalance between supply and demand is finally starting to rectify itself, which is good validation for the student loan that I continue to pay, that markets do work, right? And when you have this imbalance between supply and demand, higher prices lure supply back into the market. That is what we're starting to see play itself out, and actually, that gap is a pretty good measure of what kind of price growth we can expect. This is a percentage gap between those two measures, and you can see that as it went up, prices really followed followed suit. And that's actually probably a good thing, right? Because the market has been hyper competitive for too long. In fact, just going back a couple of months, this is the percentage of homes that are selling for more than what they were listed for on the MLS. Those numbers peaked at almost 3 out of 4 transactions, right? And that number has started to come down. It's still elevated. We still probably have a supply demand imbalance here in California, but it's not as red hot as it was 6 months ago. And I think that is good news for buyers who are still eager to get their foot on the property ladder. What's interesting is if you look at LA County and you look at it by price segment, the top end of the market's actually more competitive this year than it was last year. So even as we saw transaction growth really slow, it's actually still, there's still an appetite out there for homes, especially in that kind of 1 million and up price segment. But we do see homes staying on the market a little bit longer in general statewide. And even though homes are closing after having gone pending in less than 2 weeks, if you look at the kind of vintage of homes that are still active out on the MLS, those numbers have started to go up, and they're now 25 days old on median, which suggests that, again, homes aren't selling as quickly. You have a little bit fewer, less buyer activity. You have a little bit more options, and that takes some, relieves some of the pressure on market competition, again, which is a good thing for home buyers. But when you look at list prices, right, not just closed sale prices, but list prices, it does suggest that moderation in market competitiveness will cause the growth in home prices in California to start to slow. In fact, we're already seeing the median list price drop from where it was at this time last year. We don't expect a big retrenchment in closed sale prices overnight, but sellers are kind of finally coming to grips with the reality that they're not as firmly in the driver's seat as they have been over the last 18 months. So that's kind of the bad news, if you will, on the housing market side. Although I think the quote unquote bad news still represents more opportunity for buyers, which I'll touch on in just a moment. But we also have the economy to worry about, right? And when you look at the inflation numbers, you can see that it re-accelerated. In fact, core inflation was running about an 8% year-to-year pace, right? That means that the cost of stuff, food, what have you, gas, all of that stuff, haircuts, services have gone up by essentially double digits, and they've been in that neighborhood now for the better part of the last year. And that is why we have a Federal Reserve that is so hyper focused on raising rates to try and kind of rein in this increase in consumers. And of course, we know that the Fed just raised rates by 75 basis points last week. But to me, what's the more relevant statistic is this dot plot, what they call the dot plot. On the right-hand side here, each dot is a member of the Federal Reserve Voting Board of Governors, and this is where they expect that interest rates, the federal funds rate, needs to be by the end of each of these years in order to get inflation under control. And this has increased dramatically, even from what they were broadcasting 3 months ago. At the March meeting, there was a median expectation that by the end of 2022, we'd be in the 2.5% range. That has since been upwardly revised now to a Fed funds rate of about 3.5%. You can see their expectations for 2023 are a little bit higher, and they don't really come down much in 2024 either, right? And a lot of this has already been baked in to mortgage rates, which, the Freddie Mac number last week hit 5.8%. You can see it in the 10-year bond number as well. This is where the esoteric macroeconomic data kind of, where the rubber meets the road on that in terms of impacts on the housing market, right? Because this filters through to borrowing costs and purchasing power for buyers out there. And when you think about where rates are going on the basis of that, well, let me step back. If you think about where rates were coming into this crisis, it's fairly easy to come up with 30-year fixed rate mortgages, right? Because you have a federal funds rate, you have something the econ nerds call the yield curve, which is the difference between short-term and long-term interest rates, which typically historically runs at about 100 basis points or 1 percentage point. And then you have a gap between those long-term bonds and mortgage interest rates, right? Mortgage rates are slightly more risky than government bonds, and that typically runs in the 170 to 200 basis point range. Well, if you just apply that logic and look at where we were at the beginning of the year, that largely explained our 3% mortgages, right? We had a 25 basis point federal funds rate. We had about 100 basis point yield curve, which was almost smack on the historical average, and same for that mortgage rate spread, leading to the roughly 3% interest rate that we were at to start the year. So if you apply that same logic forward on the basis of what the Fed says they're going to do with the federal funds rate, you can see that we're probably looking at a best case scenario for the end of next year, predicated again on a 3.5% federal funds rate, of 6.5% mortgages, right? And there's a potential worst case scenario where they're not able to rein inflation in and end up going even past 3.5%, meaning that we could be looking at rates, in the 7.5 to 8.5 plus percent range. That should be a huge motivator for buyers who are kind of waffling on the fence and not wanting to, or not knowing if they want to move forward, if they want to enter a kind of wait and see mode. And let me show you why that matters so much, right? Because roughly we're at a 5.5% mortgage rate, although it went up in the latest weekly data, but this is our interest rate, the effect of purchasing power of changes in interest rates. This is a tool that we have embedded on our website. And I set it up just for a hypothetical buyer in Los Angeles County with a household income of $200,000. They want to put 20% down and have a relatively moderate, debt to income ratio, with, meaning that that household is ultimately targeting a monthly mortgage payment of $5,000 a month. Well, at a 5.5% interest rate, to get that $5,000 monthly mortgage payment, that household can afford reasonably, based on these parameters, an $880,000 home. In addition, they can afford basically 2 out of 5 homes that are currently available on the MLS. And you can kind of see the characteristics of those homes on the bottom here. What happens if rates go up to 6.5%, right? That was our worst case scenario. Now, to get that same monthly mortgage payment of $5,000 a month, they've lost almost $80,000 worth of purchasing power, right? So they're now shopping for homes that aren't $880,000. They're shopping for homes that are now $800,000, and that becomes much more tenuous, because the lower you go down the price scale, the fewer homes are actually available. In fact, instead of being able to afford 2 out of 5, you're now able to afford roughly 1 out of 3 homes. What happens if rates go up to our worst case scenario of 8%? Now you're talking about losing about $175,000 overall in total purchasing power, and you lose even more homes because you simply can't afford homes at those higher price points. So again, rising rates have a big impact, not just on how much money you spend on interest over the next 30 years, but on the house that you can actually afford. And that should hopefully be a factor when buyers are looking at whether to move forward or not. The challenges I think that we have are mostly external at this point, right? Because again, we're seeing consumers spend money and maintain that pace of spending even in the face of inflation. But if you look at how we've kept retail sales going over the last couple of months, it's really come at the cost of increased credit card debt and reductions in personal savings, right? That we've really run pre-pandemic levels of savings rates down now in half, while at the same time really running up a lot of bills on the credit card. And that simply can't go on forever, particularly with a stock market that's, in my opinion, still overvalued and likely to correct further. Meaning not just that folks will be facing higher rates, higher prices for goods and services, but also they'll be kind of poorer to boot. And the reason why that matters, again, is because consumer spending is about 70% of the economy, and it's been roughly 90% of all of our economic growth over the course of the last year or so. And so if consumers do take a step back, then we have that macro exposure as well. And the Fed is really walking that tightrope, trying not to kind of the data nerds call it inverting the yield curve, but creating so much short run risk, fighting their, in their war against inflation, that they actually sabotage the broader economy in the process of getting that under control. So that's the bad news, right? We see a market that started to shift. We've got macroeconomic concerns that we need to keep our fingers on the pulse of, because it will affect housing. The good news is that we've got much better fundamentals, and it's not 2008 all over again. In fact, if you look at the people who went into forbearance and got kicked off by the end, A, those numbers were down about 90%, and B, when you look at how people got out of forbearance, there's not a lot of systemic risk there that could precipitate the next REO crisis. About 1 out of 5 people who went into forbearance never even missed any payments, right? About 12% missed some payments, but have already gotten caught back up, right? No systemic risk there. You had a few that amortized it into their existing loan, but you had almost 30% of folks work with their banks and actually take missed mortgage payments and just tack them on to the end of the loan. There's no $20,000 balloon payments that you got to kind of come up with to be able to stay in the home. You just end up making 12 extra payments in 2053 or whatever the case may be. This shows that banks really learned an important lesson last time and kind of aren't leaving homeowners to fend for themselves. Another 15% actually modified their loan, got a longer term, lower rate. In some cases, these folks came out of the pandemic with even lower mortgage payments than they had going into the pandemic. And you had about 7% who got into trouble, but unlike 2008, they had equity in the homes. These were high credit individuals who put money down, et cetera. They got into trouble, and instead of throwing the keys back to the bank, they were able to just sell the home. And so what that means is that ultimately we're looking at less than 20% of the roughly 8% of homes that ever went into forbearance that we've really got to worry about, which means that we're looking at probably single digit REOs as a fraction of the market, not 60, 70%. In fact, California is outperforming the vast majority of the rest of the United States when it comes to the percentage of mortgages that are actually still current. So not only is this not a kind of broad nationwide issue that I think is puts us on the precipice, but actually this is an area where California is punching above its weight. The last thing I'll say is that, again, when markets shift, that means new opportunities. And I think especially for the home buyers who've been so frustrated, taking so many bites at the apple and not being able to get it done, to actually get your foot on the property ladder while rates are still low. First and foremost, the benefits of home ownership are alive and well, right? If you look at net worth in the United States, it's about $121,000 as of the most recent data. But if you break that down between owners and renters, you see that homeowners are the ones that have generated all the wealth, and that renters are essentially no better off today than they were 40 years ago. This is what buyers need to be focused on, not kind of timing the market and doing all this whiz bang financial engineering and buying low and selling high and all of that stuff. You buy, you sit in it, and you accumulate equity that kind of pays dividends for the generations to come. The other thing is you actually have more options and less competitiveness in which to achieve that goal, right? Because homes that are still active have started to reduce price a little bit, right? We had more homes active on the MLS last week that had a price reduction than we've seen at any time since the start of the pandemic, right? And so it's not as hyper competitive. You can, I don't want to say take more chances, but I think buyers have the opportunity to be a little bit more strategic as opposed to just kind of, taking the offer as it stands on the table. We know people still want to buy homes, and the percentage of first-time buyers is still elevated in the marketplace, even though it's down from those kind of ultra high levels a few years ago. And there's fewer homes that are actually selling above asking, and they're taking slightly longer to sell. So again, even as you kind of see the challenges out there and the macro uncertainty, there's a lot of reasons that buyers want to stay in the market. And even as that's true, you're still talking about a market that's attractive for sellers, right? You've still got most homes selling above list price, just not 3/4 of them, right? You've still got homes that are going pending in less than 3 weeks. It's just not going pending in less than 1 week anymore. And so I think that for all of those reasons, it's still a great time to sell as well. And so again, when you put it all together, yes, the market has shifted. Part of this is just a normalization after a feeding frenzy, but I do think that we should expect further tightening as that macro environment starts to downshift. And even as there's probably not going to be a big foreclosure crisis, we're not going to see that 20 and 30% growth in home prices. That growth will probably cool, but it'll probably come more so at the expense of transactions. So be that expert for your buyers and sellers. There's a lot of conflicting information out there. Take that data-driven approach, get them focused on what really matters, right? And I would say the same is true for sellers. I think that there's going to be people that are going to make an incredible amount of money over the course of the next couple of years in real estate, but it's going to be the ones who really don't take it for granted and keep their nose to the grindstone and again deliver on that value proposition. So with that, I will leave it there and say thank you so much. Again, we revised our projection down, so we're going to probably hover in that 380,000 unit range that we're at right now, although our expectation is that we'll end the year with higher prices than we originally forecasted. So with that, I will say thank you so much to Paula for the opportunity to be here, and thank you all for your time.